Only mode.
Hey everybody, Preston Brent here with our Trader User Group 155th edition of our weekly roundup. Boy, I've been doing these for a while. Glad you guys are sitting in on this. What we're going to do is take a look at where the markets have ended through March 17th, 2017. You know, I could read off a long list of potential landmines in front of us. You know, first we're at the second longest bull market in history, which really has started, depending on whether you're counting the futures or the SPX, March 6th or March 9th of 2009. We've got extremely low volatility, very low. We're also at about 108 plus days without a 1% drop in the markets. We've got a ton of geopolitical risk out there now, some recent events over in the Asia Pacific area, especially with North Korea. And of course, we got the political landscape over in Europe with the rise of populism. We've got investors, smaller investors, which tend to be late to the party. We've seen a huge inflow in ETFs over the past 4 or 5 months, mostly by small investors, while mutual funds have been net sellers of ETFs, which is considered more sophisticated money. We've got forward PE ratios that are at high levels, not extremely high, but high levels. I think the forward PE right now is a little over 18 and a half. The average is about 14, 15, somewhere in that area there. So we've got just slightly above average or richly valued equities. Plus this past week we had the Feds come out and raise the rates, but it confused a lot of people, especially a lot of retail traders, common investors that thought underlying assets which would move down actually moved up. So we'll take a look at all of these things, but really the most important thing that we do, and I want to emphasize to all of you out there, especially those of you that have followed me for a long time on these free weekly updates, is that we follow price action, and price action is going to tell you when this bull market is coming to an end. Now, granted, from 2009 to now, we have not had a 20% drop. We did have a pretty good drop in 2011, but it really never held in overnight hours, so we really didn't broach the official 20% pullback. So this is the second longest bull on record, and it is one of the longer runs without a 1% drop in the S&P, as I said, 108 days. So we've got a lot of reasons to be a little bit cautious here. But how will we know the bull is over? Well, when it's over is how you're going to know it's over. But from a price action perspective, what I want to do is just kind of give you an idea of something. I'm going to clean up the screen for a second here. And generally, as a bull market is coming up, it makes new highs, and then we come up and we make new highs, and then we're coming up and we're constantly making new highs. And in these drawdowns that we have, right? Here's a drawdown, here's a drawdown. You know, there may be a consolidation period. You know, we may have another drawdown like this, and the price comes down again like that. As long as these drawdowns essentially are, you know, a correction is considered a 10% drawdown or a counter trend move, because the overarching trend clearly is up, right? But as long as these come in, these down moves come in like 10%, 5%, or even like we had in October, or not October, in 2011 of around 19%, 20% is the defined beginning of a bear market. And just so that you guys know, statistically, every time we have more than a 20% pull down and it's defined as a classic bear market, it never really stops at 20%. We generally will go down to 25 to 40%, right? And generally the average is around in the mid 30s is kind of where we find the bottom before buyers come in, right? Because fear sets things off until buyers are willing to step in. But getting back to our uptrend market here, generally, we're gonna know, right, that the markets are starting to do this when they start to come back up. Well, let me get the right color pen. That would help, wouldn't it? So generally, when the markets start to come back up, and as they're coming back up, we make this new high, and it starts to steepen. So the vector or the curve vector of the market is like this. But then the vector starts to shift like this. This is considered late money, all right? Meaning dumb money, meaning what we classically call in our user group rat brain traders, which I have a trademark on, by the way. But anyway, rat brain traders. And we've got this situation here where the smaller investor is always late to the dance, right? As I said, on ETFs, which typically rat brain traders, retail traders commonly buy, we've seen a net inflow dramatically over the past 6 months. And for the mutual fund and some of the smarter money, they've been pulling out of some of these equities. Let me... Excuse me, I had to sneeze. Whew. So anyway, we've got an acceleration here of the vector, the upward vector. Then we have the requisite pullback again like this. So now people are in this mindset, right? That, well, heck, we had a pullback here. You know, we had a pullback here, we had a pullback here, we had a consolidation here, we had a pullback here. So under the term recency bias, people go, well, heck, it happened here, it happened here, it happened here. So here we're going to get buyers stepping in. And sure enough, buyers step in. But what happens is it turns out to be a bull trap. Buyers will step in, but then we won't make a new high up at this level. We will pull back just a little bit here and perhaps take out that prior pivot low, right? And then people will go, well, when are buyers going to step in? And let's say they step in here and they drive it up. And we may even come up and hit a prior pivot high right here, but then it'll roll down and then eventually take out that pivot low, and now we're making lower pivot lows, and it gives us that downward channel that now creates the high possibly has been formed. Okay, now you can see this pattern repeat itself time and time and time again, but the key is the all-important time frame. All right, remember the markets trade, and people trade on multiple time frames, or you've probably heard the term fractal, where depending on what time frame you're looking at, you can find a bullish market in a downward market. You can find a bearish market in a bullish, strong bullish market, or not a bearish market, but you can find a bearish trend or a bullish trend in a counter trend based on the time frame. You could go to a tick chart and you can find bullish trends in a very overtly bearish market, or vice versa, or a 3-minute chart, 5-minute chart, 10-minute chart, and on up to a weekly and then a monthly chart. Okay, now traders, as traders, we have to make a decision. What time frame are we going to follow? What time frame are we going to trade? Or a 2-hour or a daily? What time frame do we trade, right? Because clearly, if you want to catch the beginnings of a bear market, if you only trading monthly charts, you could be down dramatically in your portfolio before it's registered on a monthly chart. It's going to be registered sooner on a smaller time frame. But the problem is, if you go too small, it could be just a counter trend move in an excuse me, in an overall bullish market. So, like we do in our user group, and which is why we've got a lot of folks that are coming in, is I use a combination of multiple time frames. And you'll see the wiser, smarter traders doing that, or people that have been experienced. I've been doing this for 25 plus years. And you know, you'll see me generally hopping between the 2-hour and a daily. I'll use a weekly as a reference. Sometimes I'll go into a monthly, but generally these three are very good. Okay. And I will define the initial indications of a bear market on a daily chart. That'll give me the initial indications. And then I'm looking for confirmation on a weekly chart. Within a monthly chart, it could just be overall consolidation, a very wide consolidation period, like we had in 2015 and 2016. Although we suffered, you know, a 10, 14, 15% pullback in most indexes. In fact, the RUT actually had a brief 20% pullback. But in the overarching scheme, it was a wider consolidation pattern on a wider time frame. So what are we looking for? We're looking for a higher high that does not come, and then we start to shift and we've already put a high in place. What time frame do I like? I like the daily time frame for that. Then I'm looking for confirmation on the weekly. Remember, folks, everybody loves to sell at the highest high and buy at the lowest low, and that's impossible. You cannot build your strategy and long-term success in a 7 or 8 figure portfolio on that kind of thinking. What we're looking at is any trend, that moves up and then it gradually starts moving back down again. What we're looking to do is capture essentially 60%, 70% of that trend, right? And then as we get towards the top of that trend, we see a consolidation, and then we see the reversal of that trend coming back down. And whether it comes down and hits the prior lows down here, or it stops here, and then it reverses back up again, remains to be seen. But you've always got to keep these time frames on mind. Now, I'm not even talking about option strategies or currency strategies or future strategies or options on these or synthetics or any of the other things. I'm just talking about merely reading the charts to be able to say, what is my bias in the trade that I'm executing, all right? And this is why we always follow the major indexes, because the major indexes generally control, anywhere from 20 to 30%, 40% of all the trading volume in the entire market. That's where the big money is either hedging their equity portfolios or they're using it to trade zero, flat, meaning they're just going in to capture volatility, or they're going in to capture premium decay in an option strategy, a complex option strategy, which they've got algorithms and black boxes used to trade. Now, us, as mere mortals, we're only trading the direction, and we're maybe in and out of a trade in a day, a week, a month, 6 months, but we're trading, we're like those feeder fish on giant whales, or like those birds that are always sitting on the back of a friggin' rhinoceros. We get fed, we win, and the rhinoceros wins, right? So, but what you do not want to do is be that dumb feeder fish that happens to be food for the bigger fish, and you swim right in front of him and he eats you. You want to be on the right side of the market. So we're always looking for indications that the market is going to be rolling over. Now, if I take this off the screen here, right, and let's just go back to the chart here. But I wanted to give you that kind of quick overview. If you look at the chart, you can see I've got a lot of different lines and colors and bars on my screen. Some of them are price related, they're pivot points. Others are related to technical indicators like Fibonacci extensions. Others are psychological barriers like the opening price for the year, the high price for the year. Those are what I call headline numbers. Anytime you hit a headline number, it's good for the Rat Brain Business Journal of the day. That would be the National Enquirer, or the USA Today, because they do nice, colorful pictures that people can, connect the dots on. And you look at this, and you see where we've got potential stop points along the way. And then, of course, I add some of my own indicators on the screen, and I use eSignal as my charting platform because it's probably the best out there. Now, if you look at this, you can see that on the E-minis, S&P 500 futures, which I like looking at, I use as my baseline, right, to help me. Generally, when the markets are in a bullish market like we're in, stock correlations go down, which means you have some stocks overperform, underperform, and then perform at market, right? Meaning they're not beating the SPX, they're performing in line with the SPX. So it's a stock picker's paradise. When markets start falling and we get into a bearish market, all correlations go up, meaning generally you get 9 stocks out of 10 that fall when the market has a hard down move. I don't care if it's a good stock or a bad stock, it's going down for the day if the markets are having a pretty good little pullback, which, by the way, we haven't seen in over 108 days or so. So looking at this chart, just to show you where we've been since the presidential elections, right? And this was the low. And by the way, the low on the presidential elections right here, we were actually in the red for most market indexes on November the 8th, 2016. the indexes were in the red in overnight hours. Now, we put in contingent buy orders. I had our group, because we were up at 2 o'clock in the morning watching the results, because we knew it would be a binary tradable event. And I was telling our members to put in a buy order at 17,750 on the Dow futures. And then, you know, the rest is history. But you could see here that we were in the red, and then since then it has just been a rocket ship up. And in fact, you can see the vector is increased from an overarching vector here that started a little bit earlier in time, and then a longer term vector, it looks something like this. So you can see this vector is getting steeper and steeper as we go up. Okay, now one indicator that I've got on the screen here which tells me that we're still in a buy on the dip kind of scenario is that we have absolutely zero bed, which I call bearish divergence. And I use other indicators in addition to the MACD, and I tighten my MACD. It's non-standard settings that I use on my MACD. But you can see here that it's a buy on the dip, which would suggest the vector of the 50 EMA is going up at the same vector of this higher vector upsloping trend line. And you can see the vector on the 200 EMA, right, going up very high as well. So everything is pointing up. And we never did get across in the 412 EMAs. So again, we're still in this buy on the dip scenario, all right? I believe we'll probably come up and take out 2104, but if we don't, one of the things I'm going to watch for is this high already been put in, or can we make a higher high? Or if not, are we going to start to roll over? Well, we need time for that, and I'm using a daily chart to really analyze this to see, right? 2-hour charts, hour charts, tick charts. I mean, we could be in a downward counter trend move for sure. But on a daily chart, I'm using this to kind of set this thing up. Okay, we're on a buy on the dip right now. Now, how high can it go? We could have one of these exhaustion kind of moves to the upside here. If I take everything off my screen, with the exception of Fibonacci extensions, and what I did on these fib extensions was and let's just put it on a weekly chart so you can see where I use key pivot highs and key pivot lows for the extension. What did I choose as a key pivot high on this extension? Well, it was this high here that we got stuck at for a long period of time. You can see from this point right here to this point here, when we finally cleared it, you were looking at right before the this goes all the way back to February 2015, okay? And then we had the debacle in February 2016 where we came all the way down here and formed the lower low. And we had a double test right there. We took out that low, we took out that low, but we had a ton of support right in that area there. And we held, right? And then we were off to the races again. And we got our group long right in this area right here. But then all the way over here to when we finally broke out on November the 8th, right? In 2016. So we were in this really for a year or so, right? So from February 2015 to November 2016. So about a year and a half, maybe a little bit longer than that, we finally broke out. So by that token, what I did was I said, okay, that's a valid pivot high, that's a valid pivot low. That's the only reason why I chose it. And then I did some extension numbers right here. And you can see these extensions. I'm on a weekly chart. You can see we hung up here a good deal at a key extension 1.38. We hung up here for about a week. It's just one bar here, but we hung up at a week at 1.5. And now we broached the 161 and we're sitting here, and that's going to serve as support for us, sitting right at around 23.41. But you can say where to from here because it's all dry powder. We've never been up here before, right? So where can we go, right? Where are we going up here? Well, again, I've got another extension which is double, which puts us at 24.68. So you could say anywhere from the 24.50 to the 24.75 because it's really more or less a zone up in there, which would, in my mind, give us the final exuberance push before we start to have a little bit of a drumbeat to the downside. And I think the downside is probably going to see us settle in right around that 50% fib area, which is right at about 2,300, by the way. So these are what I'm looking for on the weekly chart. There is absolutely zero bed. I don't see any. So on the daily chart, there is no bed. On the weekly chart, in fact, it's increasing. So that tells me that we are clearly still in a buy on the dip. So granted, I've talked about the second longest bull run in history, the overtly low volatility, the complacency, 108 days without a 1% drop, geopolitical risk, smart money coming in, or not smart money starting to hedge more, get on the sidelines more, investor money, rat brain money starting to pour in right now. We've got a steepening vector of the upsloping trend line. Forward PE ratios relatively higher than normal. Yellen came out with more of a dovish scenario, which I'll show you the asset classes that moved in the opposite directions that most people thought, but I told everybody that's what was going to happen in our user group. So all of these things seem to indicate that, yes, we've got more upside, but I don't expect it to go on very long. And maybe it's already happened, I don't know, but we're going to follow price action, and I will keep our members in our group pretty much on top of whether we're in a correction mode, meaning we're down 10% to 19%, or we're in a simple pullback counter trend mode, less than 10%, but a little bit of a scare, or it's just a simple dip mode. Right? So these are the things that we need to understand. And then once we understand these, then the option strategies that we deploy, or the futures strategies, or the options on futures, or synthetics that we're using to deploy or hedge our portfolio, is where we're going to go. If you're not a member of our group, I would highly encourage you to come in, because this is why, we're building a lot of folks. Now, I had just started what I call a secret trader room, where you can come in and get into our daily chat room and our secret traders and follow us on the trades that I'm placing. And you'll see that so far last year we had a good year. This year we're off to a good year. But to be honest, anybody can make money right now if you're buying long. But what's going to be really cool is watching us make money when the markets start rolling over. We're just doing good wherever the markets go, because we're picking up the trends and we're putting the right strategies on the right option strategies based on the given environment and the volatility levels and things like that. So this is what I'm looking at on the S&P. Now, there's a number of red flag or yellow flags that are sitting out there, as I've kind of cautioned all of you on, right? And I talked about them at the very beginning. If we come into our 2-hour chart, you can see the all-time highs here. And you can see this little bit of a pullback here. It's looking like it's forming kind of like a 3-4-5 Elliott wave pattern, which would suggest we could move back higher. Again, would not surprise me at all. Would not surprise me to see us come up to 24.25, 24.50, as I showed on the daily. What I'm looking for is, is this the all-time high, and will it hold, or will we break it and go higher? If it holds and we start making lower highs, then that'll send me just a little bit of another yellow flag up to say, okay, are we in for a little bit more of a correction? Until we get that 1% drop, because most traders now, again, that is a headline number now. The minute we get a 1% drop, you'll see every headline newspaper say, we had a 1% drop, and then the talking heads on TV will come out and say, is this the beginning of something more sinister? I promise you that's what's going to happen. However, members in our group and smart traders, we're going to look at this from a different perspective. We're going to look at this to say, okay, let's start looking at all the various time frames, key pivot points, and we'll know if this is just a bigger opportunity to buy on the dip, or let's just see if we're going to shift over into a sell the rally kind of mode. So these are what I'm looking at on the E-minis. If we look at the Russell, and let me go back to the daily chart for a minute just to kind of give you a perspective here. You can see how close we are to the highs here, all-time highs on the E-minis. But let's look at the Russell, small cap and mid cap. You can see here we had a little bit more of an aggressive pullback. In fact, for the Russell, we pulled back below the opening price for the year. We were there for over 4 days before we finally moved back up above the 50 EMA. Okay, and we had that bearish divergence, which suggested the pullback in the Russell was going to be not an initial buy on the dip, let it sell off, and then let's get confirmation that we'd want to be a little bit more aggressive here, or just adding to our longs. And that seemed to work itself out, but we're stuck here. So the Russell is going to be one of these indexes that we're going to follow very closely. The strongest one of the group, obviously, is Nasdaq. And as you guys heard me say before, or I was telling our members Sunday night, a pair trade, shorting Nasdaq and going long the Russell made the most sense because you had a wide gap between the relative performance of the two. And if we look at the Nasdaq futures, you'll see what I mean. The Nasdaq futures actually made a new high, all-time high, this past this past Friday. So we were making new all-time highs. But now, and you can see here, leading up to that all-time high, there was absolutely zero. And I said this last Sunday, there was a zero bed here, right? We were going up like this. But now this potential pattern setup here suggests that any pullback and a final thrust higher to go with the rest of the markets may move it up like that, and then it'll give us a bed, which suggests not necessarily a change in trend, but a pullback to one of these key pivot points right here. And the Russell may pull back too, but on a relative basis, the Russell will outperform the Nasdaq. So that was the basis for last Sunday's pair suggestion that I threw out to our group. Now, I did not take it in our secret trader, but we're going to start doing some of these pair trades because to me, it's low-hanging fruit. And the probability of success is relatively high. And you can see we're nudging up against the all-time highs, and you can see the opening price is near the dot-com bubble high in the Nasdaq futures, the 100 futures. The other one that I'm watching here very closely is if we look at the Dow Jones transports. You know, the Dow Jones transports are a lot uglier. They're falling. And we've taken out the 50 EMA and they're moving even lower. So this is another yellow flag we got to follow. They tend to lead the markets higher and lower. And if this thing starts going lower, it could portend we may get that 1% drop in a bit sooner than you may expect. This past week was triple witching, so in a traditional triple witching week, Mondays and Tuesdays tend to see a little bit of a pullback. Wednesday, Thursday, Friday, because everybody's rolling quarterlies, monthlies, futures, indexes, everything is all rolling. The volatility seems to pull back a little bit, and then the following week we tend to have a burst higher in vol. Now, volatility futures expires this next week. We've only got a few days left, and then we go out to April, but they're very, very low, guys. And I may just roll my long. I'm long volatility, and naturally I've got a loss on it, but it's hedging the rest of my portfolio. And I'm looking at rolling my vol futures out to the April month, all right, because I do believe in the next 3 weeks we're going to get that 1%. Keep in mind the longest run is 155 days in the Dow, and I think in the S&P it's like 138 days. So that would suggest we could run another month without having a 1% pullback, or a month and a half. Statistics and all-time highs and lows are meant to be broken. But I just think we got a lot of headline risk out there. We got a lot of things starting to come to fruition here. So to me, I think the volatility, the chance of a big push is going to be to the upside rather than the downside. So this is the Dow Jones Transport. So we're going to be watching all of these. The other one that's really interesting, if you look at the All World Index, it's also doing very well. VEU, it's Vanguard's all world index, and we made new highs here too. Look at this thing. It's just continuing to move up, make all of these highs here. Let me just adjust a couple of things on my screen, and you can see the 2017 open price, and it's just up and running, right? You can see the really degraded performance over here with the Brexit vote, and then right here leading up to the Trump election, and then it's just, you know, the whole world was more afraid of Trump. It actually sold off after the election, but then when it saw how the U.S. markets were reacting, because look at this. This is an interesting tell here. If you look at it after the Trump election, when it looked like Clinton was going to win, the All World Index was moving up, and then as soon as Trump won, it fell. It came down. Unlike our index, it did just the opposite. But because the U.S. can pull everybody else around, you can see that eventually it said, well, hell, it looks like the U.S. is fine. They're moving up stronger. So away we go. And boom, now we're up at this level here. We could have a scenario where the U.S. markets underperform the remaining part of this year and the rest of the world performs. But it's going to be the big thing on this is the geopolitical risk over in Europe. Now, there's going to be some trading opportunities coming up, and I'm going to point them out to our members here as we move through the spring and summer months. But these are just some indexes I'm following, guys. Now, just another thing here that I also found very interesting. The bond market. The bond market after the, and let me just put it on a 120-minute chart here. You would think once Yellen raises the rates that we would have the bond market going down. But as you look at this, right, and you look at what happened, the bond market just went sky high, right? If we look at the markets, and when Yellen raised the rates, what are the markets doing, or what's the bond market doing? Up, down, up, right? Just like that. Because the bond market, as Europe gets better, as the euro gets stronger, you're going to see money come out of bonds. However, you're also going to see some other hedging and some interesting things taking place in the bond market where this Fed, Janet Yellen, we call her Aunt B, aka Aunt B, delivered a really sweet, tasty blueberry pie, her recipe for the economy, full of fat and butter and sugar, meaning even though we had a 25 basis point rate hike, from 75 basis points to about 100 basis points is where we're sitting right now. She was able to do this while being more dovish than hawkish. She said they will remain accommodative and they're going to stick to their guns of 2 more rate hikes. Now, this was all forecasted in, but the way she said it, she said they're going to remain accommodative and they're not going to be trying to reduce the balance sheet, which could affect some of the currency and bond markets. So the bond market had already sold off in anticipation of a more hawkish Fed. We got a more dovish Fed, which is kind of what Yellen's forte is. And then sure enough, away we went. So I will give her kudos. She did a good job, although it's still confusing, but they're kind of providing a little bit of this measure to keep the dollar lower. They do not want the dollar to get too far askew of the rest of the economy. Because remember, Europe is still doing stimulus. China pulled back a little bit, but they're still doing stimulus in selected sectors. Japan is still doing stimulus. They left their rates alone. So the dollar is the lone holdout here, and the Yellen does not want the dollar to be the only currency that's moving up. So if we look at this and look at how good of a job she did, if you look at the currency market, look at what happened to the dollar. The dollar fell off after the Fed said, hey, we're hiking the rates and we're hiking them 2 more times. You would think the dollar would move up, but the dollar came down because of the way she delivered her statement and because of their policy, accommodative policy, and the way they're treating the balance sheet. The dollar actually fell lower, and the euro did just the opposite. So she accomplished her mission. Most rat brain traders thought, well, higher interest rates, higher dollar. But the dollar had already worked up to this point. If we go to the 2-hour chart, you will see here, the dollar had slowly worked its way up, and then this was already pre-built in. So this pullback to area here, we may even pull back to this area here. And then I think the dollar is going to find a bottom right here until we get more news out of Europe or other areas. Then the dollar is probably going to find a home somewhere in this area right here. But it tricked a lot of people that weren't just aware of what could happen. In fact, I put in our chat room for our members about T-minus 15 minutes from the announcement, I said, watch bonds, watch the dollar, and watch gold. And I actually traded gold because gold did just what the bond market did. Right now, gold and bonds are kind of moving together. Look at what gold did. Let's go down to the 2-hour chart. Gold moved up over 30 points. Gold did just the opposite of the dollar. Generally, when the dollar gets stronger, gold gets weaker and vice versa. Look at what gold did. This looks just like the dollar chart, only just the opposite. And I got long gold futures right in that area there when it looked like, yeah, my thesis was correct. And gold just went screaming higher. Now, there's going to be a limit to where gold goes for the near term, because we do have 2 more rate hikes, and gold does not like higher interest rates. But I tell you what, it's also got, which is also providing an impetus to a push to the upside, is inflation is benign right now. I do believe this year the interest rates aren't going to go as high as people think. I think inflation is going to stay relatively benign. I think interest rates, they're going to go, while they're going to go up a little bit, they're not going to go as high as you think on the long end of the yield curve, which would be that bond chart. But this is kind of where we're looking right now. So I'm looking, quite frankly, for possible longs in the euro. Now the euro, what else helped the euro move stronger? This is the euro futures. What helped it move stronger was they had a positive election in Holland. Geert Wilders and his Freedom Party came in second place, but I kind of knew that was going to happen. They've got like 33 different political parties in Holland. They're unlike the U.S. where we have 2 parties, and then we got a party within each party, the alt-right and the loony left. So we've got, and then you got the middle in the U.S. But over there in Holland, they got like 33 parties. So the winner, they're very diluted, so they've got to form a coalition within the government to get anything done. But the net populism is picking up votes and picking up strength in their parliament all across Europe. But this is this also, but the boost, the fact that Wilders and the Freedom Party actually lost, was enough to goose the euro higher. Now, I do believe Super Mario Draghi, Super Mario, is going to be forced to pull stimulus off, because we're starting to see signs of higher inflation in Europe than we are in the U.S., believe it or not. So I think that's going to make the euro go higher. And remember, it's not really the U.S. dollar, it's the U.S. dollar index. It's based on a number of different currency movements. And if the euro is getting stronger, that's about 56, 57% of the dollar index. Generally, these 2 move in opposite directions. So that's kind of what we're going to see. The other thing that I wanted to show you guys is oil. Now, oil is a really interesting thing. And I'm going to adjust my chart here to show you guys. The 2017 low has been broken, and we made a new 2017 low, right? Remember, there was an overhang of supply in the U.S. crude market. And just by some studies, and I was looking at some of this stuff also in Barron's, generally the refineries maintain, on average, they were maintaining about 64 days of supply, right, in their demand. So they had overhead, and over the past 10 weeks or so, inventory supply levels were going up, not down. So OPEC came out last year and said, we're going to trim production by 1.2 million barrels a day, blah, 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 blah. It tended to drive oil prices higher, right? So if we look at the daily chart, they came out with that and said, we got to get the overhead supply, or the overhang, down. And you saw oil, you know, doing one of these numbers right here, going straight up like that. Now, what's happened is, up at these levels up here, a lot of U.S. shale frackers and others are selling in the forward contract month in futures, because they're going out in December and January and February of next year and guaranteeing prices for oil at, you know, $58 a barrel, high levels. And now they've locked in a selling price. So now they can withstand sharper downdrafts. They've also gotten better in cost control, and frackers with technology, they can pull a well offline, put it online in 30 days, whereas before they couldn't. So I think net, this is going to reduce the influence of OPEC, and it's just going to get worse and worse. Now, and then last week, the IEA, I think it's the International Energy Agency, they came out and said that oil inventory levels are very high. In fact, right now the average oversupply is about 466 million barrels, and that would take OPEC another 14 months at their rate to draw it down. So I just think oil is, and we're making good money on our oil trades right now. I think on the high end it's 60. Right now on the low end it's 40, and oil is probably going to stay in this range for this year. We may visit the lower end, which is what I'm calling for. Remember, as we get down into this lower end, then the correlation between the oil markets and the equity markets go up. You'll see almost tick for tick moves, as we saw when oil was down around 40. $39 a barrel. But we're using these to our advantage in the markets using options on these things, and it's really working out nicely. So that's the energy market. And then we've got some things that I'm looking at in the ag market that we haven't done yet. We just took a synthetic futures trade off in corn. We made money on that one. And I've got some things going on in the soft market. So this is where the markets sit right now. I wanted to spend a little bit of extra time on some of this stuff just to give you guys an appreciation of what we're doing for our members in our group. If you're not a member, I highly encourage you to come in. Just take one of the offers I got here. If not, that's cool. You can look at the free updates that I do on the weekend. No big deal. Because we're having fun in the markets, and that's what they're entitled to do. And I believe as we come in here, it's just really interesting. Don't get sucked into the trap here of being a perma bear. I've got a lot of friends and very successful traders when the markets were down here. As it's been going up, they've been trying to short the market, and they just lose the entire time. Let the price action tell you what you want it to tell you, right? And then don't use this recency bias to affect some of your decisions. And then control your risk, and you'll be fine. If you're in our group, you'll be able to come in and see what we're doing, and I think you'll pick up a pretty good bit. But anyway, enough of the sales pitch. I don't need to do that stuff. Have a great weekend, everybody. Members, I will see you this Sunday night. Hopefully we won't get any more of this friggin' snow this weekend here in New England, but I'm told that we may get a few inches, so oh well. Better than a few days ago. Have a great weekend, everybody. Members, I'll see you tomorrow night. Ciao, folks.